Late last week, investors were confronted with a scary headline. Ratings firm Moody's cut the rating on U.S. debt. And it's reasonable that this would concern investors. I mean, it sounds like a pretty important thing, right? An entire country's debt rating being reduced. But while it is admittedly a scary headline, it is not something we need to worry about from a market standpoint. And here's why. The Moody's debt downgrade revealed nothing new. Moody's cited high deficits and rising interest expense as a percent of GDP as the reason for the downgrade. That's the equivalent of saying water is wet. We know. Fiscal deficits have been a problem in the United States for decades, and rising interest costs is something we all expected given the debt explosion that occurred following the pandemic. The Moody's downgrade revealed nothing new that implied these problems, which are issues over the longer term, have suddenly become worse. Instead, Moody's simply joined the party. Standard & Poor's, another rating agency, cut the U.S. debt outlook more than a decade ago, and Fitch, another ratings firm, cut the U.S. debt rating just 2 years ago. So in the end, there are a lot of scary headlines in this market so far in 2025, and we're all doing our best to navigate them. The key is understanding which scary headlines are meant for attention and page views, and which are actually going to impact the economy and stock and bond prices.